And everybody, welcome to this afternoon's session of the Lion's Cage. This is the profiling of a very interesting company called Neu Capital, and it's also some views on investing in Africa by Barry and Mark. And they've written some articles which are very interesting. But Neu Capital is a particularly interesting business. Mark's going to tell you about it. And Invest Africa, a business that I founded, has a strategic partnership. So I'm slightly conflicted here, but it's not a conflict if you announce it. So Neu Capital is an incredible matching platform. And the beauty about the conversation today and what they're going to tell you is they have non-stop conversations with investors and opportunities, and not just investors in Africa, but international. So on that note, Mark, lead away. Fishman.
Thanks very much, Gordon. Much appreciated. I thought I'd just tell you perhaps a little bit about how Neu Capital fits in and why we have a pretty good knowledge of what's going on in the market. And perhaps just to introduce that first, if I can just put the presentation on. Let's pop that up. Right, you can see the slides. So the first one I thought probably worth just introducing that we are a bit like a Tinder for African capital. We reach out in the unlisted market to people who are looking to invest $5 to $50 million US in Africa. We want to speak to anyone who's doing that, and particularly across the world. So that world map is probably very difficult to read, but I'll tell you briefly what it says. We talked to about 280 investors who write tickets of this size. The dark areas represent where we raise the capital for the destinations, Africa and Australia and New Zealand. So we have offices there, but we focus really only on Africa. And we source capital from the dark areas and also from the lighter areas from the US and Canada, across Europe, Middle East, and Asia. So we have about 50% of our African investors are local and about 50% are offshore. In fact, slightly more are actually offshore. And they spread between debt and equity, about 25% in debt, about 25% in debt and equity, and about 50% in equity. And a mix of credit funds, family offices, private equity investors, DFIs, sovereign wealth funds, and the spread's really important so that we can address investment requirements across the market. So that's probably the useful thing to know about the investor spread that we speak to. Briefly, how we fit in: we're not advisors. We don't advise. We don't. Advisors sit. If you look at this little diagram, advisors sit on either side of the capital raising process. They write the IM, they prepare the financial model, they strategize with the client, and then they reach out to the market. So the middle three blocks of what we do: we do the launch of the deal to the investor community. We bring them anonymously into the deal room once they've signed an NDA to show them some more information about the deal. And then finally, we provide a shortlist back to the advisor or the investee who's raising the capital, and they execute on the deal. So we really just do one small thing in the process, which we think is one huge thing, and that is we know how to accurately connect the right investors with the right investment opportunities. That's all we do. And we think that's pretty key. So that's the kind of the where we fit into the ecosystem with corporate finance advisors and in the process. And then finally, probably the last one just to show you is in the 2 years to the end of 2019, we looked at 529 leads. We vetted 223 opportunities. We made proposals to 31 companies. We only engaged in raising capital for 14, but that represented over 2.5 billion rand. So it's a significant amount, an average size of about 170, 180 million rand per deal. And since the end of last year, we've been very, very active with COVID-19. So I think maybe just to step away from that, then if I can, I'm just going to close that for a moment and get back online. Right. So walking through what we wanted to talk about today, I suppose, was to say that one of the things we do get to see is investors very often competing with each other. And because they're competing with each other, they often don't know what each other are doing. So we get to talk to a lot of investors and understand what many of them are doing. So we get to see a particularly unique perspective on what investors are doing. And similarly with advisors, many of them competing with each other and don't talk to each other with the frankness they talk to us. And as a neutral party in the middle, New is for neutral, we tend to see the world in a very different way. And it gives us some insights we thought might be useful today. I think maybe just to jump then into why we thought this was an exercise, why we wanted to write these articles. And broadly, it was because a great deal gets written about the public markets. You can pick up stuff every day of the week on what's happening in the listed markets, but very little is written about the private markets. They are very, very hard to get information on, and secondly, they are very illiquid, so you don't just get to trade in and out. And the vast majority of Africa's entrepreneurs are actually unlisted. They're private businesses. And so the listed commentaries are useful, but they're not always of that amount of value. So we see the COVID-19 pandemic is accelerating a lot of trends. There were many businesses already in trouble before this exercise. Before the pandemic or the lockdown took place, and this process has just accelerated many of these trends, and many businesses will collapse. We're going to collapse anyway. They're just going to collapse faster. What we want to do is address two sides of this. So one was, what are investors looking for in Africa at the moment? Because it's changed dramatically. And secondly, what do we think is a framework for identifying the winners? And what do we think those might be? And it's a little more speculative. We try to think in the medium term about that. So I'm going to talk briefly about what the investors are looking for, what we've seen change. And there's been some significant changes. And secondly, Barry will talk briefly about what we've seen what we see happening in the market from a perspective of who we think might be the winners. So jumping in quickly, we looked at a couple of different types of investor, and we picked the mezzanine debt funds because we think they're really, really important in Africa at the moment. But the reason is that they often will provide a rapid solution. They take some equity risk in the process, obviously, but where you're a listed company or you're an unlisted company, they prevent dilution from taking place at the level that it would otherwise take place if you were to raise equity, and you can do it quickly. The problem with raising equity, it's much slower. You've got a valuation event. You have to negotiate or renegotiate your shareholders' agreement, and that's troublesome. So mezzanine funds we see as really important. We see that the rates of return haven't, although the markets has dropped in South Africa anyway by 2% since the lockdown started. Mezzanine investors have not adjusted their interest rates. They're actually looking for more security, but they're very active, and we think they're a key part. So we thought we should mention them first. Key part of the capital mix when you're raising capital. Secondly, the banks. So the banks, wherever you've got a regulated institution, they're regulated for the simple reason that they have to provide an additional certain level of prudence to the economy of a country. And so they're regulated, so they can't do crazy stuff. They're prevented from doing that. And we see, for example, in the traditional banking environment, liquidity is key. There's been moves to prevent dividends from being paid out in South Africa by the central bank. We expect to see similar moves across the continent, mainly because you can't have your banks failing. So they don't get to do what they want. And so the point is then that they have to look after liquidity, they have to look after existing clients, and really third on a list, and it's a long way down the list, is looking at new investments. So we see that the banks are retreated from the markets and are not financing anything at the moment. So we thought, or very little. So we thought that's an important insight, and that's changed dramatically in the last 2 months. These government-backed guarantee schemes that we see, we don't think they're really going to make much of a difference to fill a capital gap. They're really there just to help businesses survive. So that helps businesses survive, but it's not going to solve for people wanting to raise $5 to $50 million US. And then the other thing is that the private equity is a bit different. Private equity can take big risks. They're not regulated like the banks, so they're not told what to do with their balance sheets. They can choose what to do, and they can do stupid stuff if they want to. But it also means they can do clever stuff. And we see in the private equity space that there's if you've got dry powder as a private equity fund, you're loving life. If you've got a long time in your fund still to run, you're loving life because you're not up against it trying to sell out of your private equity investments within the 10-year limited period that you have in which to operate. So we do think that the primary divide there is whether you have cash on your balance sheet or not as a private equity fund. Besides the maturity by which you have to exit your investments. The second thing that's important about private equity funds is they source their capital from limited partners. And we see that the limited partners are becoming less patient with private equity funds that want to extend their funds. So if they're up against the 10-year barrier and they've got to sell out quickly, the limited partners are much less interested in extending that period by another 2 years. So we think that's an important thing to note, which does mean that assets are probably going to move out of private equity funds a little cheaper than they otherwise would have done, because they have to move. We thought it might be also useful to say that we see that in America, certainly, some of the limited partners are reneging on their obligation to fund. And we think that you will find generally in many of the limited partners, liquidity is important, and they're not letting money go as easily as they were. So FDIs, multilateral and development finance institutions. They're obviously guided a lot by government policy. We sense there's a little bit of a retreat back to the home country, so money that might otherwise have been left in Africa. We think some of that's going to get redirected back to the home country because it has a better political feel in a deglobalizing world. We think that the DFIs are going to be much more focused on essential services and economic reignition. We also think that impact investment is an interesting place to be. We see that we think that the trends towards impact investment will accelerate as a broad statement, and the various requirements to have a solid ESG plan in place. Sovereign wealth funds. So unless you were one of the oil-backed sovereign wealth funds that covered forward before the price war with the Russians, and we think there were a number of them that did manage to do that. If your sovereign wealth fund is funded by a commodity which is now dropped in value, expect to see less money flowing from them, and we think generally sovereign wealth funds are going to find we're going to find capital is a little less accessible from them. And then finally, just on family offices, the story with family offices is that they're very different. They don't tend to have mandates. They tend to operate as they very much as they wish. They're not obliged to have a mandate or a particular strategy. They often work with relationships over and above strict mandates. And the benefit of that is that many of them are still investing. And we are seeing activity from them, and we are also seeing that they're fairly evenly, not evenly, but they're fairly divided between those that are preserving a legacy and are much more risk off, and those that are very entrepreneurial still, and perhaps more recent generations, and are looking, in fact, to take advantage of this current market. We think that the family office is a very important part. They're a very big part of our investor makeup. We think they're a really important part of the capital mix going forward over the next certainly 2 to 6 months, while people are trying to shore up balance sheets and COVID-proof their businesses. So that's in a nutshell, not maybe a big nutshell, a coconut shell, a view on what we're seeing in the investor market and some of the expectations we have. With that, I'm going to hand over to Barry. Unless there are any questions at this point, but we can otherwise we can jump over to Barry on the just what we're seeing in the areas that we think, the sectors that we think will be.
I think let's go straight through to Barry.
To invest in over the next 3 to 4 years.
Thank you, Mark. Yeah, so we had a huge inbound number of requests for funding from companies, and in order to try and triage that, we actually came up with a classification of sectors around those that we thought were broken, those that we think will survive, and those that will probably thrive, that should thrive. The idea there was is in terms of the different appetites for funding and the feedback we were getting from the investor network, because they really didn't want to get into seriously distressed assets. They wanted to be able to cherry pick the really good stuff, and the things that had an opportunity to continue going forward. Gordon, in his infinite wisdom, got frustrated with our long, broken, survive, thrive categories and said, let's just call it the good, the bad, and the ugly. And so we'll start off. I've actually got the lists here, and we're going to start off with the ugly or broken category, and Gordon's going to knock off the first few, which are property related. So Gordon, over to you. I think you might be on mute there, Gordon. No, we've lost him. He's had a bit of a mute problem there. Anyway, so the first few are property related. As soon as Gordon, are you back, Gordon?
Yeah, I'm back. Sorry about that. Can you hear me now?
Yep, we can hear you.
Okay, great. Sorry. Yeah, just briefly on the property industry. It's quite a controversial industry, and I think before COVID even struck, it was in serious trouble as an industry. Just look at the REIT sector, and you'll see most of them have lost significant value. But also the industry itself is very segmented. So to make a broad brush single statement about the industry is actually probably quite naive. I mean, it's segmented. You've got retail, you've got industrial, you've got residential, you've got commercial offices. Then you've got segmentation by geographic location. And then within that, you've actually got the micro location as well. So you've actually got to deal with all of those. And we don't want to hijack this session with a property discussion, but just brief comments. You know, the offices and commercial space. Increasingly, people are going to work from home. Less densely occupied space is going to be sought after. Tight desk configurations are going to be of concern, particularly in call centers, a place like that. So the ones who will probably benefit from this is your commercial real estate. I think they call them CRES, commercial real estate services or occupier services, who are professionals who design workplace, design layouts, what's healthy, and particularly those professionals who have international links and can follow best practice. They should do very well. If you look at retail space, we've seen the transition from high street to malls to big box value centers, and then finally to online shopping. So I think we need to understand that retail is not dead. It's just the nature of retail that we see and that we engage will change substantially. It's definitely going to become a tenant's market. And, you know, the kind of tenant fit out that a landlord can give as new tenants come in, trying to trade out of their J curve, as it's a new business, they've got to be more empathetic to that. So increasingly, it's going to be a very tough market. What we are seeing coming to market is quite a few payment solutions, which will offer, facilitate customer payment. So the kind of tenants that can embrace those best and quickest will probably do the best. And then looking at industrial, the lockdown's been very disruptive to supply chains. And we have seen a bit of a blip in warehouse, logistics warehousing, which is required. And I think going into the future, that will be required, but there'll be an increasing focus on the actual quality of the warehousing space. Does it have your 12-meter slab to eaves height clearance? Does it have the right technology, the right energy? Does it have the right circulation space? Definitely your older style industrial premises, which are very difficult to repurpose and are obsolete. I'll battle to see those coming back, and they're going to remain problematic. Residential is a whole separate discussion because it's such a segmented industry. But on the rental market, it's the landlords that can demonstrate an empathetic tenant response retention model, we believe will actually come through strongest. And then just generally the micro location. I mean, if you've got a property in Clifton, which is a highly sought after destination, all that happens is the queue of tenants that were queuing up for your property might now come from a different source. So we believe some of those will remain. So on residential, each specific location will have its anomalies, and that's a long separate debate. Then there's other properties like hospitality. The hospitality sector is challenged, and once again, that's a big debate. You know, will sort of safari trips now be more popular because they're open vehicles, and the whole theme of those trips is sparsely populated space in resorts. You know. But definitely we'll see a change in hospitality, and I think it'll take a while for that to recover, and it will change substantially the kind of experience. And then without going into Sub-Saharan Africa, the trends will be very similar, but that's largely, I mean, the challenges in Sub-Saharan Africa, which have always existed, is liquidity, corruption, and infrastructure, and those still remain a challenge. You know, and those are relatively small economies as well. So on the property sector, we do have views, but then even within our views, there's subcategories. But that really covers it, Barry. Thanks very much for the purposes now.
Thanks, Gordon. Yeah, so going down the list, aviation, international, not much pushback on that. Business travel, and aligned with that, the business hotels and accommodation. There's just going to be a less demand as we do what we're doing right now online as opposed to physical meetings. Cruise ships and the Petri dish effect, entertainment and the arts, specifically high density attendances, audiences and venues. That's going to be a problematic and people will be avoiding that. Cinemas, attractions, casinos, same theme. And then conferencing, any sort of physical conferencing, so that's going to be in line with reduced business travel. Printed media, we've all been accessing a lot more online, and that's going to continue. It has been a structural trend anyway. Automotive cars, so especially luxury cars, it's probably going to be as a result of push on consumer spending. But if we're not traveling so much, we may not need 2 cars, we may not need such a flashy car. Clothing and textiles, this has been a little bit of a contentious one, specifically non-essential fast fashion. We're not going into the office so often, we're not going out so often. But then also maybe there's a bit of a trend towards health and fitness type clothing. Public transport, the infection risk would be, with large-scale public transport would be high. Perhaps not so practical for that to see reduced demand in our country, but certainly it'll be at the margin. Call centers, high density, we saw those were very quick on the profile of potential infection hotspots. Online bookings, they need to look at the way they operate, how much they control funds, and being able to actually offer refunds, terms and conditions, and there's probably a lot of rework going on there. Construction, certainly large scale, reduced project funding, and then also depends on what government priorities are, but the big projects are probably not going to be around for a long time. Luxury goods, specifically in the mid-market driven, there's going to be pressure on consumer spend. Tourism and leisure, high volume and international travel mainly will be at risk. If we go to the bad, so these are business models that are under pressure, but they should survive. But certainly management will need to be looking at reworking their business model and how they can adapt to the new world. Manufacturing, so there's a lot of supply chain scrutiny. There's been demand destruction, and then there's also workplace hygiene in terms of how they configure themselves. Education, in terms of the traditional model, will probably leverage a lot more online. And then there's energy. There's going to be pressure for alternatives, and then perhaps less dependent on oil and gas. But we'll be looking at that oil price and grid parity to keep fueling that. Mining, it's going to be hygiene and workplace related. Then there's also going to be the demand for their products from international growth. Industrials, the value chain, digitization and supply chain dependencies. So digitization is a theme that's going to come through a lot. And then packaging is a big opportunity to push the hygiene emphasis side. Agriculture, large scale agriculture is probably going to shift towards more locally sourced and enhanced food security. Construction mid-size, well, it should be okay. Financial services, the large institutions tend to be slow to move. They've been disrupted by fintech. That's going to accelerate. Insurance is interesting, and specifically life insurance. So you will have policy lapses across the board in the short term and life, but you'll also have new business growth under pressure, which is critical for a life insurance business to maintain its valuation. There's also asset liability mismatches that could cause problems with the way they're regulated and capitalized. Traditional banking, switch to contactless, low cost de-risking. Then there's entertainment, live sports, so empty stadiums. Do we really think that's going to come back? Are we going to be happy? I see Bayern, the Bundesliga had the first live football on the weekend, and they had, I think, 16 or 17 million viewers, but how long is that going to last? Those stadiums lack atmosphere, and that edge is going to be gone. Then if we keep going down, the knock-on effect for above the line advertising. So if you're not watching live sports, will that have as much appeal? So you should see that declining. Apparel retail, pressure on discretionary spend, more functional clothing. Rental accommodation, Gordon's covered. And then we're looking at private healthcare. Now, who would have thought in a pandemic, private healthcare would be under pressure? But obviously as a result of lockdown, there's no elective surgery, and that business model is under significant pressure, which is bizarre. Call centers need effective distribution model. Restaurants and bars, quite contentious that one, whether they will survive at all, but certainly there's going to be a reconfiguration, and the volumes won't work so much anymore. Gym facilities, same story. Ride sharing, Uber, electric cars. The point there being, if I'm going into the city, as opposed to using public transport where I have high infection risk. I may want to use Uber or ride-sharing or even an electric car. So that could drive a bit of demand there. Luxury goods, ultra high-end should survive, but the mid-market would be at risk. Then if we switch to the good, business models that should thrive, and these are ones that actually need to be fed capital and the resources required to fuel their growth. So hospital, medical facilities, those bespoke facilities, distributed hygiene, flexible businesses, medical supply and services, scientific research, specialist medical, so trend to smaller facilities, increased demand. Then we've got personal healthcare, pharmaceuticals. You should see an increase there as we all look to have much more of a healthy lifestyle. And potentially demand for beauty products as well. Nutraceuticals, trend to healthier foods and supplements. Information and communication technology is a standout winner in this, in terms of the whole digitization process and networking, bandwidth, e-commerce and online trade. Big fight for that to have that lifted in our country. Data connectivity, so we've all been looking for cheaper sources of data, better bandwidth, and be able to do calls like this. Simplification of the solutions as well. Telecommunications and networking, so connecting, getting the home office, the remote distributed businesses, getting them all connected. That's going to be a winner. Streaming technologies. So we've been shifting away perhaps from our DSTV subscription, looking at Netflix, YouTube, a lot of other sources of entertainment. Online gaming and gambling. So I've heard of a number of pools of friends now rather gambling and playing poker online as opposed to their physical Thursday night poker evening. Esports, that could be taking over from traditional live sports. And then online video conferencing, like what we're doing now. Fintech, definitely a big opportunity there. 3D printing, we've heard that come about in terms of making ventilators, and just distributed mini manufacturing facilities. Semiconductors, tech, hardware, retail, and the high street. Gordon touched on retail. And then the last of this list is the food retail, food and convenience, so ready-made foods, the fast food outlets, drop in traditional restaurants, so taking market share there, food processing, agriculture, local and niche. So we're all sitting at home, we're entertaining, cooking for ourselves, fresher produce, better local source produce. Food security is important. So that's actually seeing quite a strong demand for that sector. And then home delivery, logistics, online education, and how much we can do with that. Content creation, just in general, as we compete for people's attention. Sportswear, health and fitness trend, and just comfortable stay-at-home clothing. Online exercises as well, massive. So you can see unfortunately, the yoga and Pilates studios down in the local neighborhoods are really suffering as a result. There's really good content online. DIY and home improvement, remote living, trend away from the cities. Gordon touched on that as well in the property space. And we can have a home in the country as long as we've got infrastructure and internet connectivity. We can actually do very well there. And then alternative energy to fuel the smart home office and have more reliable power. It's important that in our home office we have reliable power. And then low density experiential tourism. We do think that will eventually come back. So nature travel, people appreciating the environment a lot more, game reserves, camping, country hotels. Maybe some of us will start camping. So that's pretty much the list that we've got to date in terms of the discussions we've had. I see there's been a number of questions. The first one there was talk us through the contentious sectors. So construction, is it completely broken? Will it survive? We saw different components of that fit between the different categories. So there's been a lot of discussion around there. For us, agriculture has been a very interesting one. We've seen farms have not missed a beat during this lockdown. They've been able to continue with their operations, and in fact, if anything, have seen demand for their crops, especially niche crops, lift quite significantly. Citrus, bananas, macadamias, the berry crops, a lot of the health cash crops. They've become their traditional source of funding is also somewhat dried up, and they're very fundable. Some of them are exporting. They've got good food prices, and they've had the benefit of the exchange rate as well. Healthcare, very contentious. We talked about we talked about the private healthcare and how that business model, ironically, is actually taking strain in the health-related pandemic. Autos, also tricky. Clothing, And then beauty products, as I understand, is coming out of the wars. People are more conscious about what their appearance is, and even in calls like this, how they might appear, and spending more money on home-used beauty products. I've got a few more questions, but I see there's been some from Mark and Gordon. I don't know if we want to have a quick pause there. Mark, if you guys want to pick up some of the questions that you've had. Mark, you're on mute, Mark.
So thanks. Rob picked up a couple of questions there. I think I've answered a couple of them there. I think was fairly straightforward. But I think that the two that are probably more interesting is one is how the investor attitudes will change. Are they changing permanently? I mean, I don't think investors will change permanently. There will always be a need to place capital and to find good investment opportunities. It's just that I think it's going to take a long time. I mean, people think that the investment markets in the private sector will return as soon as everyone's back out of lockdown. That's not going to happen. It's going to take much longer than that. The supply chain issues to worry about. But perhaps more interestingly is what should you be doing now? And, you know, the thing about looking for investment at the moment is it's fine to... The point about these being unlisted markets is that if you want to go and pitch a deal to private equity fund, you've got to get right to the front of the queue, because the problem is that the funding will remain available for the right deals. So prices may drop because it's now going to become a buyer's market, but much more importantly, the key demand is going to be for the resources in that investor's team. How are you going to get to the front of the queue? And if you're not at the front of the queue, how do you get there? And this is a key issue that we concern ourselves with when we work with our clients, when we're working with people who are trying to get in front of investors. So the thing to do is get ready now. Don't wait, because these are not liquid markets. Get into the queue, get ready, and you've got to hit the market quickly. It helps if your business does not need too much of a physical due diligence. That can make a difference. We're already seeing due diligence being conducted on 2 investments at the moment remotely because they're listed, because they're technology businesses. But really, don't wait, is my advice. Even if you don't launch right now, get everything ready as soon as you can. That's my advice. And the reason it actually is relevant is because when the Ruperts and the Oppenheimers put their cash into the market to support small business. I mean, I know that I was told by business partners that they were I think 2.3 times oversubscribed within the first 4 days of saying they had R1 billion to invest. So, you know, if you were in the first day, you were there in the queue, you're better off than the guy who was there on the 7th day. So my point is, the problem is the resources within the teams that are investing. You want to shoot on those? Anything you want to add to?
No, I mean, there's another question here. If my business is in the bad survive category, what actions should management undertake to make their businesses more appealing to investors? There's actually been a few articles written, but one of them which stands out for us is actually put together by Rob and Adam Craker, called the Jumpstart approach, which stands for jettison, uplift, mothball, pivot, or start something new. It's quite a useful framework to think about how to approach your situation. There's a lot of material on the McKinsey website around COVID-19, and they also have a framework, a 5-point framework, which refers to the 5 horizons. So they've talked about resolve, resilience, return, reimagination, and then reform. So those are all taking longer and longer timeframes as they get implemented, given that it's the 5 horizon reference. But quite a useful framework to think about how you should approach your situation.
I think the one, if I may jump in here, the one area that people do tend to forget is mothballing. There are some businesses where you can just close the door, close it up for a year, you know, keep a sort of bare bone crew cleaning the pipes and fixing and painting and getting it ready to relaunch when the markets come back. And people always assume that, you know, it has to be tough it out, survive. But there are lots of ways you can actually say, I'm taking it off the market for a year, as long as you don't have debt. You know,
so very good example of that, Rob, is high-end lodges in the bush. the feedback they're definitely going to come back, but nobody's going to be flying for a year to use them. So exactly as you say, that I think would fit squarely in that category. If you've got the financial wherewithal to maintain the asset, you're definitely going to be in the game when the things do come back.
So I read an interesting article today by Andy Kessler, who's a friend of mine, in the Wall Street Journal, and I want to get him on a webinar. And he said where the world's going right now is uninflation, deflation, uninflation. And that expensive iPhone and iPad or tech product that is made for very little, and you're charged a huge amount. Those prices are coming down, and all prices are going to come down, plus wages, and that's going to be the tough bit.
Yeah.
Because if everything else comes down, rent, the lot, and it's as you say correctly, the renters have the hat on, they're wearing the crown. Wages are going to have to come down too. But I believe there will be a deflationary period and then an inflationary period, maybe hyperinflation in certain countries, and I worry South Africa may be one of them.
Yeah.
So you got to time that right.
That's a good point, Rob. I was going to say that I just wanted to add on to something that you were talking about just a little earlier with Barry, and that is that one of the things we've seen in this market, capital is a strategic weapon. In days when things are good, capital is a commodity, but it needs, I think at the moment it's actually a strategic weapon. And if you look at certain industry types, and depending on, as long as there's not low barriers to entry, if there's reasonably high barriers to entry and there's a new market developing, and we're seeing it in the tech space, and you're the one who can get funded, you become the king of your patch and you dominate that market, and everybody else who's racing to keep up is just going to fall off the wagon. So we've had the clients, for example, in the tech space say to us, look, we've been knocked down big time by the investor. The investor wants to halve our what we think the business is worth, and we think it's as good for. The point is that they will monopolize that particular sector that they're playing in if they take the money, and that puts them in a position to demand, to extract value down the track that is significantly better than just simply taking a hit on valuation now. So I think that a lot of it depends on the strategic situation of that sector and the business. But it's counterintuitive again. Just rather take the money. It's a strategic thing.
Mark, there's a friend of ours, Dermot Desmond, our Irish buddy, who gave me his advice. He went to cash probably a little too early, but he's in very good shape. And he said the winner will be if you're still standing, not cash in the bank. If you're still standing and able to play the game in a year and a half, you win everything. Generational opportunities are yours. And he said that even now, sit tight. But we've got some questions coming up here, some good questions from Stefan Zingale. Stefan set up a great housing business in Central America, and then he came to Africa, teamed up with a very important Egyptian investor. And his question is, gents, within the gloomy outlook on property in general, any thoughts on the affordable housing space in Africa? The absolutely enormous deficit across the continent, I suppose, will only get worse. What's your view there?
Yeah, if I can answer that one, we'll give it a go. Stefan, good question, and thanks very much. I mean, the affordable housing space, there's no question there's a huge demand for affordable housing in South Africa and in Southern Africa. And it is a very vexed space because historically, I think they used to call it gash housing or all your affordable housing models failed right up until about the year 2000. I used to work for a REIT in Pretoria, Johannesburg that were very big, in fact, the biggest resi REIT. And one of the challenges that they need to deal with that's emerging now is just what's the payment culture. There's definitely a need for these houses and people will definitely want to build them. Will there be off-takers and what will the payment culture be like? If they go into a rental pool, we're quite keen to see how the payment culture emerges in the next 3 to 6 months. But if they sit within a well-managed management structure, as the one that I worked in previously, had a very robust management structure, very fair, very honest, and they managed their structure and their arrears very well. It worked very good. And I saw that in East Africa as well. Affordable housing was starting to take off. But once again, it depends on the management company and how experienced and solid they are in that discipline. So do I see a future for affordable housing in Africa? Absolutely, I do. But it just depends how the masses play and what the payment culture is like, and also the affordability. If everyone's losing their jobs and they can't afford the affordable houses, and there'll be no appetite for anyone to go into that market. But it's a market I would love to see run very hard because there is a big need for it. Yeah.
Edward asks a question: with a low interest rate environment in Europe and the US, how are investors thinking to do in terms of yield with respect to Africa? How are they going to achieve yield return in Africa?
How quick was that typing, Rob? How quick was that typing? Oh, good. Yeah, I think the yield question is huge. We've got to be competitive in Africa, and I do think that we will see some big adjustments in prices. So, and that's going to be the only way, I think, Edward, to achieve yield, is my sense. Not the only way; it's one of the ways that the yield will be achieved. Is that there'll be an expectation that the prices drop. And we've had a conversation with one of the investment committees of one of our investors, where they said to us that the crash hasn't happened yet. It was quite disturbing. And they're looking at one of our investments, and the attitude is the crash hasn't happened yet. It's not even begun. So it's just begun, but it's not really happened. So I'm not sure. That's pretty bearish, but I tend to be more of an optimist than that. But it's a perspective that we're seeing.
Because I think, Mark, the reason they say that, there was a great cover on The Economist that had Main Street, Wall Street, and a big divide, like a chasm between the two. And it said the big divide. And what has happened is Main Street's been decimated. And Wall Street still has got some punch in it. And there are people, myself included, that think the crash is about to come. But, you know, yeah. I've been wrong before, but not in the last 3 months. So hopefully I'm wrong now. So, guys, do you have no more questions from anyone? I don't see any more questions here. Do you guys want to make sort of wrap-up finishing statements? It's quite an impressive lineup of people here. Natalie Colby of Actis, Mbwana Ali from East Africa, Ken Ray, who's a very top S-Biz broker. Come on, Ken, you got to have some tough question on. I guess this is not a listed discussion. Craig Stanley, Andrea Barry from London, Namibia, really. Andrea, come on, you must have a question. And Telia Lazon from Mozambique. So here we go. Mbwana Ali is asking a question. He says he liked the high-end lodge question, given he's in the safari country, which he is. So, guys, unless there are more questions, I think we're going to wrap this up. Would you like to make finishing statements, guys?
Sure. Thanks, Rob. Thanks very much. Look, I think the first thing to say is end lockdown. Thanks, Gordy. That's end lockdown. I think that it's probably worth simply saying that the list that we put together of sectors, no one really knows what exactly is going to happen there. And even if you're in the airline industry, there are going to be winners in the airline industry. Someone's going to survive and be the winner there, but it's going to be tough as hell for most people. So our objective is just to stimulate a conversation, I think. Finally, just to say, we spend our lives trying to understand how investors think. We spend our lives trying to concern ourselves with how to match the right people with the right opportunities. To some extent, we play a bit of a gatekeeping role. Certainly, when we talk to the investors, who we appreciate enormously as an enormously important part of the ecosystem. And if there are any questions, anyone wants to get in touch with us to talk about what we do at Neu Capital and how we do that, there's on our 2 articles, you'll find at the very end, as Barry's, Gordon's, and my email addresses. Just give us a shout. Very happy to have conversations about this and also to learn. We don't know everything. We know a lot of people. We know a lot about this industry, but we really don't know everything. And anyone who tells you they do, time to run. Thanks a lot, Rob.
Thank you, Mark. And the charts, the sort of bad, good, bad, and the ugly. Remember that movie? Those charts, are those going to be available because they're very interesting?
They're on a PDF. They're on a PDF, and they don't pretend to cover mining very carefully, for example. So it depends. These are the conversations we've had with investors. Rob, they're not like we sat down and did an empirical piece of study that said what's the whole market look like. These are just snippets of conversations we've had with people who put real money to work in real businesses in Africa.
And Mark, just before you flip to the other guys, were you really South Africa's senior swimming champion for a micro minute? Were you really?
For a micro minute.
As you turn 50. As you turn 50 in a day, is that right?
I turned 50. I was briefly there. No, it was.
And can you swim backwards? Can you swim lengths backwards? I've seen you do it. So just.
Yes.
Okay.
I'm missing surfing, Rob. We're missing surfing. In lockdown.
Ken Ree asked a question. How should the Rand perform given gold is breaking out? The Rand's going to 25, 30 in that region. So the Rand's going down.
Ouch.
Barry Gordon, any comments?
I think don't waste a good crisis. There's so much opportunity out there. Go for it.
Yeah, I think Mark summed it up well. Yeah, just in lockdown.
Guys, thank you very much. And thank you to our audience. We're going to rock off, head out, and have a great evening, everyone. Mark and team, Gary, Barry, and Gordon. Thanks, guys. Well done.